Hey there, this is Gene Goldman, Chief Investment Officer for Cetera Financial, and welcome to the 2026 Market Outlook. Our title today is called Economic Resilience Meets Elevated Expectations. So what I'll do today is talk about our three themes for 2026, and I'll dive into each of these in terms of why the economy could be stronger than expected, why we do believe market returns will be a little bit lower than expected, and why we do expect to see a shift in terms of market leadership. If you think about the S&P 500, the broad stock market benchmark, over the last 7 years, we've had a pretty good run. In fact, the S&P 500 has been at 18% or higher than 18% in 6 of the last 17 years. It's had a wonderful run. But with that said, let's dive into our 2026 market themes. So every year, as you know, we develop three investment themes that we think will drive the economy and financial markets. For 2026, here are our three themes. Number one, simply this: we expect the economy to be stronger than expected. If you look at the consensus says the economy is going to grow maybe maybe a little bit above 2% for 2026. We do think it's going to be a little bit stronger. And I'll go over the reasons why. Second of all, we do believe market returns, as defined by the S&P 500, again, that broad stock market benchmark, should likely come in a little bit lower than expectations. In fact, we may see below average market returns. And lastly, we do expect market leadership to move away from those AI, those artificial intelligence, those large technology companies, and move more into other parts of the market that are a little bit more undervalued, like small caps, mid caps, and value. So we'll talk about all three of these and spend a lot of time in terms of why we expect this. So let's dive into the first one: stronger than expected economy. So most consensus strategists and market people out there believe that economic growth should be pretty similar to 2025, basically growing about 2% for the year. We think, on the other hand, it'll be a little bit stronger than that. And there are many reasons why. So let me talk about why. First of all, one of the main reasons is just stimulus. There's going to be a lot of stimulus in the economy in 2026, both monetary and fiscal. So monetary stimulus is basically the Federal Reserve helping to stimulate the economy, whether it be lowering interest rates, making money easier to borrow. And one of the ways they do this is they lower what's called the Fed funds rate. And we've talked about this before, but the Fed funds rate is a primary interest rate tool that if the economy starts to slow down, the Fed lowers this interest rate, again, the Fed funds rate. By lowering it, what happens? Borrowing costs start to come down, like home equity loans, like car auto loans, like mortgage rates. All of these start to come down. It becomes cheaper to borrow money, and this, in theory, stimulates the economy. If you look at this slide shows the implied Fed funds rate at the end of this year. What that means is that what the markets expect the Fed funds rate to be at the end of 2026. If you look at that horizontal line, that's the current rate where it is right now. That green ziggy-zaggy line is what the markets think it'll be at the end of this year. So basically, if you read this slide together, the markets think the Fed will cut interest rates twice in 2026, maybe even a third time. So cutting rates by 0.5% up to 0.75%. Overall, stimulus coming into the economy. If you listen to the Fed is a little mixed right now in terms of their recent statements, but their most recent dot plot, which is their document that they produce once a quarter, where they anonymously, each member indicates where they see interest rates, inflation, the economy. If you look at that document, the Fed says maybe one rate cut in 2026. So whether it's one rate cut or the markets believe two or three cuts, stimulus is coming in terms of monetary stimulus. Also, we're expected to see some fiscal stimulus. So if you think about last year in July, the Big Beautiful Bill was introduced. And the Big Beautiful Bill introduced several tax cuts that were retroactive back to January of last year. However, the IRS did not adjust tax withholding rates. So as a consequence, many taxpayers were paying more in taxes in 2025. As a result, we should see more Americans receive tax refunds in 2026. In fact, there's some estimates that could be an additional 6 million Americans getting a tax refund, with an average tax refund increasing by about $500. If you kind of play this through in terms of the effect on the economy, you can estimate maybe consumers, you and I, spend about 65 to 70% of that tax refund. So this suggests that first quarter GDP could be boosted by about 0.5%, and first half GDP could be boosted by about 0.8%. Either way, this should be some type of economic boost for our economy in 2026. Again, another reason why we think the economy will be stronger than expected. Also, if you look at this slide shows a very simple statistic. It's inventory divided by sales. And what you're seeing is that inventories are coming down relative to sales. If you take all this together and you look at the red arrow, you can see it coming down. Take everything together. This suggests that inventories are pretty low at retailers because basically companies did not import as much given the tariffs, given the other concerns. As a result, inventories have come down. This is very supportive to the economy because we do expect manufacturers are going to need to rebuild some of the inventory. Again, good for the economy. So now the question is, well, I hear all these stories about debt is at record levels. Is that going to slow our economy down? Yes, credit card debt is at all-time highs. So if you look at this chart, there's two charts on this chart. The top chart shows credit card debt. Household credit card debt is at record levels. It makes sense because our economy is booming, it's growing, people are using their credit cards. On the other hand, the question is, how is debt relative to, say, income? And you look at the bottom of the chart, if you look very, very carefully, the bottom of the chart takes credit card debt divided by disposable income. And you see the line is moving higher. But if you look at the red circle, it's still well below the average. So yes, debt is rising, but it's still pretty manageable. This is good news. If debt was too high, if it was not manageable, like we saw before the great financial crisis in 2007 and 2008, we would be worried. But debt has risen, and we do acknowledge that, but it's pretty manageable. The other thing to think about, we get a lot of questions on is, well, housing. How will housing perform in 2026? And housing is very important because you think about housing, housing is such the crux of our economy. We do think housing in 2026 stabilizes. So what impacted housing before? We had high interest rates, we had very low inventories. Really, housing really struggled. If you look at this chart, you can see the drop off in housing. But we're starting to see signs that housing is starting to stabilize, whether it be building permits are starting to pick up. The Fed has lowered interest rates, which again has an effect on mortgage rates, helps to bring mortgage rates down. But the other thing to think about is this next slide is that even if housing prices, home prices pull back a little bit, people are not going to be forced to sell their homes like they did back in 2007 and 2008. Why is that the case? Because you look here, this is owner's equity as a percent of overall real estate value. And right now, see the little red circle? It's around 74, 73, 74%. We haven't seen these levels since the 1960s. And if you look at that line that goes down and comes back up, back in the great financial crisis in 2007, 2008, remember back then everyone was just buying houses like crazy, overspending, just buying houses they couldn't afford. Owner's equity was around 45%. And as home prices pulled back, people were forced to sell because they had less owner's equity. Today, there's a bigger buffer. So even if housing pulls back a bit, there's a bigger buffer in terms of owner's equity. So again, we do think housing stabilizes in 2026, a positive for the economy. So overall, the consensus expects economic growth in 2026 to be about 2%, pretty similar to what we saw last year. We think it's going to be better than expected for the reasons I outlined. More stimulus, low inventory to sales ratios, a little bit of a stabilization in housing. Again, taken together, better than expected economy. The second theme is simply this. We expect below average equity returns. So if you think about the stock market, the S&P 500, again, that broad stock market benchmark, if you think about it, since 1933, it has averaged about 9.2%. Stock market has been very strong, averaging, again, over 9% since 1933. We do expect, though, market returns will be lower than that average. Our best guess is maybe a 4, 5, maybe 6%. I know that I said before the economy looks stronger, and I'll show you some other reasons why there's some good news in the stock market. But at the end of the day, there's one thing that really, really worries us. Valuations. The stock market is extremely expensive, and we'll talk about the ramifications of that. So again, our second theme, below average equity returns. So first and foremost, we do see a strong foundation for the stock market as a whole. If you look at this chart, this chart shows three charts. It shows that on the upper left-hand side, oil is at a multi-year low, and you see the arrow. If you look at the lower left-hand side, the dollar is at a multi-year low. And if you look at the upper right-hand side, bond yields are near a multi-year low. So what you have is lower oil, a lower dollar, and lower treasury yields. Taking that together, historically, when those three things happen, it tends to be a good foundation for the stock market. Good news. Furthermore, if you look at this chart shows estimated earnings for the S&P 500 and other major indices. So if you think back to investing 101, one thing we learned is that if a company generates more earnings, investors tend to buy the shares of those companies. So the theme, the phrase is earnings drive stock prices. So what you look in the red circle is basically earnings estimates for 2026 for the S&P 500 in green, that's large cap stocks. The dark bar is for mid caps, and the yellow bar is for small caps, those smaller companies. Overall, earnings look pretty good. So for the S&P 500, earnings look like they're going to come in around 13.6%. May come in higher, may come in a little bit lower, but regardless, earnings look pretty strong. So earnings estimates look pretty good. So we have a stronger than expected economy, in our opinion. We have a good foundation for the stock market. And third of all, we have earnings that look pretty good this year. But why do we think stock market returns will be a little bit lower than expectations? Simply this, valuations are pretty high. So if you look at this chart shows what's called price earnings ratio. So basically, it's the PE ratio. It's the price of the stock market divided by earnings. It's a common valuation measure. And basically, in a nutshell, if it's higher, the stock market is more expensive. If it's lower, the stock market is cheap. See the red circle? We're at 22 and a half times forward earnings. Is that high? And the answer is definitely. You look at the horizontal line, that's the average for the last 10 years. The average for the last 20 years is about 16. Stock market is pretty expensive. It is very, very high. In fact, the record for the stock market for this indicator is 25 times forward earnings during the tech bubble. We're about 22 and a half times. So valuations are high. So what you want to think about is, yeah, we have a great foundation, but because valuations are high, this limits multiple expansion. This limits the expansion of the stock market, in our opinion. So keep in mind, when you make an investment, it's not just about valuations. You don't just sell a stock because valuations are high. You have to look at other parts like fundamentals, technicals, and of course, valuations. What we're saying here is that fundamentals look okay in terms of the economy, in terms of earnings, but valuations are pricey. And because you have high valuations, everything needs to be perfect. No bad news, no bad news at all, because everything is priced to perfection. Another thing to think about why we think stocks could be below average is seasonality. Basically, seasonality, as you see here, we are entering the second year of the presidential cycle. And what's interesting, see the red circle, is that the second year tends to be the weakest year of any of the 4 years of a presidential cycle. It doesn't matter if it's a Republican, doesn't matter if it's a Democrat, doesn't matter whoever is in office. All this shows you here is that since 1960, the stock market in the second year of a presidential cycle, regardless of who is president, the stock market has had its worst return, only averaging about 2%. We are in the second year of a presidential cycle. So seasonality suggests that we could have some pressure on the stock market because it's the second year of the presidential cycle. Another thing to think about is that, really, equity income has more competition. So if you think about investors, some investors out there, some of you may want to say, okay, I want to buy stocks that pay dividends because I want income. Others may say, well, I want income, I'll buy bonds. And historically speaking, income from the bond market and the dividend yield of the S&P 500 tend to be very close. So if you look at this chart on the left-hand side, that what we're plotting is bond yields relative to the S&P 500 dividend yield. And as you can see, these two are very, very close. But look where it is today. And I put a red arrow there. Today it's very, very wide. This creates more competition for those investors looking to buy for income. As a result, this could put pressure on the stock market as investors say, you know what, instead of buying stock for a higher dividend yield, I am instead going to go into the bond market. More competition for equity income investing. The other thing to think about is that there's just more uncertainty in Washington. So if you think about Washington, if you look at obviously tariffs have been a big issue. The markets have sort of gotten to the point where the markets have accepted tariffs are part of investing. And one of the key things to think about is that the run rate for tariffs in terms of the money collected that goes into into the economy via, tax cuts or via the big beautiful bill or any types of stimulus, the run rate's around $350 billion. So the market has priced in that there are tariffs and this is going to our economy. But now if you look at this from a website called Cowshe basically shows it's a almost like a futures market, a futures index, excuse me, a futures website. Basically says that there's a 24% chance that the Supreme Court will rule in favor of Trump's tariffs. So this is a very uncertain event. Remember, the markets are priced in perfection. Now you start to throw in, well, maybe tariffs might get reversed, and this changes the market dynamics. Again, the markets are priced in perfection. This is an uncertainty. Another thing to think about, we are having midterms this year. If you look at the same website, the question is, which party will win the US House next year? Right now, Kalshi says it's about 75% chance that Democrats win. And the point is, I'm not trying to be very political. All I'm trying to say is that the markets have had priced in the fact that, having a Republican Senate, Republican presidency, that a lot of stimulus has been done for our economy. Now the question is, if we have a divided government, this creates uncertainty. Will there be additional stimulus? Again, uncertainty. The markets don't like uncertainty. So long story short, the backdrop looks good for the stock market. You have a good economy, in our opinion, economy that could prove to be stronger than expected. You have good earnings. You have other factors which we talked about before. But the key issue is that valuations are pretty high. Valuations are pricing in perfection. You have high valuations. You have seasonality. Again, the second year of a presidential cycle. And the other issue is that there's more uncertainty, and markets don't like uncertainty. Take all this together, our best bet is that we do believe the stock market, the S&P 500, has a return that's less than its long-term average, mid-single digits, maybe 4, maybe 5, maybe 6%. So that's our second theme. So the first theme is the economy proves to be stronger than expected. The second theme is that basically the stock market has a return below its long-term average. And our third theme is simply this: equity leadership changes. So if you think about that, over the last last 3.5 years, the last 3.5 years, leading the market has been a small group of artificial intelligence, technology, AI companies, basically leading the market higher. And, this has been, it's been moving the market higher. What you've also seen is that the rest of the market has not really kept up. Small companies, mid-cap companies, other sectors in the market like healthcare, like industrials, like financials, they've moved higher, but they've not moved as much as those market leaders have. We do think, given the dynamics of the market, given valuations, that this changes. Other parts of the market will start to lead. So first and foremost, let's take a step back and let's talk about why have we seen technology and AI lead the markets. And if you look at this slide, and this is from our friends over at Payden and Rigel, and basically it's a great slide. It's a little bit dated. It's through the end of November, but I love this. Okay, so if you look at this chart carefully, horizontal axis is years since debut. Vertical axis is the share of households. So you look in the far left-hand side, since generative AI was first introduced in late 2022, today, about 55% of households now use generative AI. It took about 2.5 years to get 55% of households to use this. Now, if you go to the next few lines, I put red circles there, you can look at the smartphone. It took about 6.5 to 7 years before we had 55% of households using a smartphone. The next line, we have social media. It took about 8 years before 55% of us are using social media. Go further to the right, it's the internet. It took about 12 years. If you go further to the right, the computer, it took 18 years. And the last dot on the far right-hand side, that's electricity. It took about 20 years before 55% of American households were using it. What this shows you is just how AI has come into our households, into our economy so quick and so fast. So this is part of the reason why we've seen over the last few years, those AI related technology companies have done extremely well. Very, very well because of this. More people are using AI. So, but our perspective is because of this, Because of this surge in AI companies, the valuations are pretty expensive for technology companies, for those big AI companies. In fact, if you look at this chart, remember PE ratio, price divided by earnings. The PE ratio on technology, the technology component of our stock market, is about 41 times. And if you look at the chart, that's pretty high. Look at the rest of the chart going back, and this goes back to 2006. You can see that it's extremely high. Technology stocks are pretty expensive. Another thing to think about is just market dynamics. So we've had a nice rally, as we've talked about before, over the last few years. It's been a wonderful rally for stocks. When you have a good rally, you want it to be healthy and you want more stocks to be appreciating as the stock market moves higher. So there's something that's called market breadth. And basically, market breadth is when the stock market's moving higher, are more stocks moving with the market. If you look at this chart, one common measure of market breadth is the number or the percentage of stocks trading above their 50-day moving average. You see with the red circle, it's about 55%. It's not that great. Usually you want this to be in the 80 or 90%. So while the stock market has moved higher, only about 55% are really moving in the right direction. This is not a good sign. This is not a good sign of a very healthy market. So the question is, why do we think that the market rotates away from those technology and AI companies? As I mentioned before, we think valuations are pretty high for technology companies and AI companies. Keep in mind, I'm going to go back to that for 1 second. Yes, valuations are high, but fundamentals look pretty good. Again, AI is the future, and you've seen it being used, as I mentioned before, 55% of households. But the problem is that, yes, fundamentals are good, but valuations are pretty high. A thing to think about, look at this chart carefully. This chart has a lot going on, but please bear with me. One of the reasons we think that the market rotates away from AI and technology companies is that historically, when the Federal Reserve cuts interest rates, small companies and mid-sized companies tend to do really well. They like it when the interest rates are coming down because it helps to stimulate the economy. If you look at this chart, there's a lot going on, but let me explain this to you. So horizontal axis is time. The light blue line that goes down, those bars, that's when market cap is outperforming equal weight. So market cap really means sort of like the S&P 500, how it's very market cap weight, where larger companies are a bigger part of the index. On the other hand, equal weight, those green bars going up, when equal weight outperforms market cap weight, the line goes higher and you have green bars. And equal weight is basically saying, let's take the S&P 500 index, those 500 companies, and not look at it in terms of larger companies moving the index higher, but instead let's say, okay, let's equally weight each of the companies in the S&P 500. And what you see here in that light blue ziggy-zaggy line is the Fed interest rates. And so what I've done, I put arrows here. So every time the Fed has lowered interest rates, the green bar goes up. That means equal weight has outperformed market cap weight. What this says is that other parts of the market are starting to lead, not just the large mega cap names. It's an important stat here. It's an important chart. So again, when the Fed has lowered rates, again, this doesn't happen every time, but predominantly when the Fed lowers interest rates, where I put a red arrow, you've seen equal weight outperform market cap weight, suggesting that other parts of the market, not just those big mega cap technology companies, will lead the market. This is another reason why we think small and mid cap and other parts of the market will start to do better. Market breadth widens. If you look at this chart from a valuation standpoint, we've talked about valuations so much. Remember, price earnings ratio. If it's higher, it's more expensive. There's three lines here. The green line at the top is the price earnings ratio of large cap companies, those bigger companies. Remember, like the S&P 500. Those next two lines, though, are the valuations of mid-sized companies, and then below that are small companies. And what this overall says is that the stock market is much more expensive in terms of larger companies, primarily those mega cap companies, relative to mid and small. We think the market, in terms of looking for better valuations, and the Fed cutting interest rates, will rotate their way into other parts of the market, not just those big mega cap names. So long story short, our third theme is simply this, that basically the markets rotate away, and we see they rotate away from mega cap stocks, and market leadership changes. So, sorry, excuse me. So for 2026, we have three investment themes. We have number one, the economy proves to be stronger than expected. Number two, is that market returns come in lower than average, their long-term average. Number three, we see a market leadership shift away from mega caps into other parts of the market. So those are our three themes for 2026. The question is, what do you do? And as we always say, there's two things you need to do. Number one, be diversified. So have exposure to different parts of the market. Why do we care so much about diversification? This chart, and I've shown this to you almost every time we've spoken, is such an important chart. A lot going on, but let me explain it to you. So horizontal axis is time, and the vertical axis is stock market returns. If you look at this chart carefully, it shows 46 years of market returns for the S&P 500. If the line goes higher, the stock market is positive. If the line goes down, the stock market is negative. If you look carefully, in the last 45 years, the stock market has been down only 8 years. So it's been positive most of the time and being down only 8 out of 45 years. The stock market has a very positive bias. And we know this because our economy is growing, earnings are growing. So historically speaking, the stock market has a positive bias. But more importantly, look at those little rectangles. Each of those rectangles represent each year's biggest drawdown, biggest sell-off, basically its biggest weakness. If you look at this carefully, every year you see the little rectangle. So overall, what the slide shows you, the stock market has a positive bias, but the average intra-year pullback, sell-off, downside, whatever you want to call it, is negative 14.2%. So market volatility, weakness in the year, sell-offs is a normal part of investing. So diversification is so important because by investing in different parts of the market in your portfolio, you're helping to mitigate some of this uncertainty because some of the investments are going to zig while other parts are going to zag. You're reducing market uncertainty. You're reducing market volatility in your portfolio. So the key crux of what we're suggesting is number one, be diversified because you want to help us create smoother market returns. The second thing we would suggest is make sure your portfolio is aligned to your long-term objectives. We've had these huge runs in the market. As I mentioned, the stock market, and you see it on the far right-hand side. The stock market has been close to 18% or higher in 6 of the last 7 years. That's a big market run. Because of this, some of our portfolios are getting a little bit disorganized, maybe too aggressive or too conservative. Our second suggestion is get in contact with your Cetera financial advisor and make sure that your portfolio is aligned with your long-term objective. Because again, over the last few years, because of the markets shifting all over the place, you may have a portfolio that's too aggressive or too conservative to your long-term objective. So with that said, I really want to thank you. I know I covered a lot. I really appreciate it. Again, we have three themes for 2026. Again, the takeaway, the therefore, the actionable investment advice is be diversified and make sure your portfolio is aligned with your long-term objectives. To do this, get in contact with your Cetera financial advisor. If you want more information, you can please follow us on X at Cetera IM. You can follow me if you want to, Gene Goldman. And here's more information, more disclosures. I will not read this to you right now, but you can see these very, very important disclosures. Again, thank you for taking the time to listen to me today. Have a great day, have a great quarter, and have a great year. And thank you.